Good morning and welcome to docket number 250103, Bureau's annual review of the rate adjustment mechanisms of the Connecticut Light and Power Company. We're here this morning for our evidentiary hearing in phase 1 of this docket. We'll begin by taking appearances followed by any administrative matters. I'll turn first to the company.
Good morning, Chairman Gillette, Commissioner Aconti, Commissioner Karen. My name is Dan Crisp. I'm here on behalf of the Connecticut Light and Power Company.
Good morning, Commissioners, Chairman Gillette, Commissioner Aconti, Commissioner Karen. Nice to see you all. My name is Lauren Bidra. I'm here on behalf of the Connecticut Light and Power Company as well.
Thank you. Attorney Wheel.
Good morning, Tom Wheel for the Office of Consumer Counsel. I'm joined today by Consumer Counsel Claire Coleman and Staff Attorney Kim White.
Very good, thank you. Is Attorney Marshall with us this morning? I'll look for her. All right, thank you. Are there any administrative matters, Attorney Crisp? Okay.
Mr. Callan and Ms. Kane are not available today. And the second administrative matter is that we are going to be interchanging these last two seats with whatever topics are the subject of that come up by the questioners. So if the questioners could announce what topics they intend to address so that we can move people into the right seats.
Thank you. And are other witnesses prepared to adopt the pre-filed materials of witnesses Callan and Kane?
Mr. Callan did not sponsor any testimony or responses, and Ms. Kane is joint testimony and joint responses with Mr. Trainer. So okay. Yes.
Very good. Thank you. Nothing further? Nothing further. Do any other parties have administrative matters? All right, seeing none, we will move into the panel introduction. Attorney Crisp, I'm not sure if you saw how we did it the other day. I think that went fine. If you could introduce the entirety of your witness panel and identify them. After that, I will ask all the witnesses to approach. We will swear them in mass, and then you can move to the adoption of pre-filed materials.
Sounds good. First, I have Douglas Horton, Vice President, Distribution Rates, Marissa Peruta, Director, Revenue Requirements Distribution, Edward Davis, Director, Rates, Michael Shelnitz, Manager, Revenue Requirements, Dave Thompson, Manager, Rates, Daniel Trainer, Director, Credit and Assistance Programs, Brendan O'Brien, Director, Accounting, David Glady, Vice President, Distribution Engineering, Electrical Engineering, Leanne Landry, Director, Investment Planning, Jeff Toronto, Manager, Budget and Investment Planning, Laura Purbeck, Manager, Wholesale Power Contracts and Electric Supply, Brian Rice, Director, Customer Solar Program, Stephen Bruno, Director, Business Operations and Support, Energy Efficiency, James Matthews, Manager, Rates and Revenue Requirements, Transmission, Bernie Bajan, Manager, Contract Center, Vendor Management, Call Center, Melissa Gagliardi, IT Project Manager, IT Customer Billing.
Thank you. If I could ask all of the witnesses who have been identified to raise your right hand, I'll administer the oath. If you're in the audience, if you could do me a favor and stand up so we can just identify you all. Very good. Thank you. I'll administer the oath. At the conclusion of the oath, if you can say affirm by saying I do. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury. Thank you. All right, Attorney Crisp.
Okay, thank you. Mr. Horton, can you please state your name and title for the record?
Yes, good morning. My name is Doug Horton. I am the Vice President of Distribution Rates and Regulatory Requirements for Eversource.
And in connection with this proceeding, did you sponsor responses to interrogatories?
Yes, I did.
Do you have any changes to those responses?
No, I don't.
And do you adopt those responses as your sworn testimony here today?
Yes.
Ms. Peruta, can you please state your full name and title for the record?
Good morning, Marissa Peruta, Director of Revenue Requirements for Connecticut.
And in connection with this proceeding, did you sponsor pre-filed testimony in responses to interrogatories?
Yes, I did.
And do you have any changes to those?
No, I do not.
And do you adopt that pre-filed testimony and your responses as per your sworn testimony here today?
Yes, I do.
I'm going to skip over Mr. Davis because he did not sponsor any pre-filed testimony or responses. Mr. Shelnitz, can you please state your full name and title for the record?
Yes, my name is Michael Shelnitz, Manager of Revenue Requirements for Connecticut.
And in connection with this proceeding, did you sponsor pre-filed testimony in responses to interrogatories?
Yes, I did.
And do you have any changes to those documents?
No, I do not.
And do you adopt these documents as your sworn testimony here today?
Yes, I do.
Okay, Mr. Thompson, can you please state your full name and title for the record? And in connection with this proceeding, did you sponsor pre-filed testimony in responses to interrogatories?
Yes, I did.
And do you have any changes to those materials?
I will change.
And do you adopt these materials as your sworn testimony here today?
I do, yes.
Next, Mr. Trainer. Mr. Trainer, can you please state your full name and title for the record?
Good morning. My name is Daniel Trainer. I'm the Director of Credit and Assistance Programs for Eversource.
And in connection with this proceeding, did you sponsor pre-filed testimonies in responses to interrogatories?
Yes, I did.
And do you have any changes to those materials?
I do not.
And do you adopt these materials as your sworn testimony here today?
Yes, I do.
And Mr. Trainer, are you also familiar with a response to interrogatories sponsored by Seamus O'Brien?
Yes, I am.
Do you have any changes to that response?
I do not.
And do you adopt this response as your sworn testimony here today?
Yes, I do.
Thank you. Mr. O'Brien, can you please state your full name and title for the record?
Sure. Good morning. Brendan O'Brien, Director of Revenue and Regulatory Accounting for Eversource Energy.
And in connection with this proceeding, did you sponsor pre-filed testimony and responses to interrogatories?
Yes, I did.
And do you have any changes to those materials?
No, I do not.
And do you adopt these materials as your sworn testimony here today?
Yes, I do.
Thank you. Mr. Glady, can you please state your full name and title for the record?
David Glady, Vice President of Distribution Engineering for Eversource Energy.
And in connection with this proceeding, did you sponsor pre-filed testimony?
I did.
And do you have any changes to that testimony?
I don't.
And do you adopt this testimony as your sworn testimony here today?
I do.
Thank you. Ms. Landry, can you please state your full name and title for the record?
Hello, my name is Leanne Landry. I'm the Director of Investment Planning for Eversource Energy.
And in connection with this proceeding, did you sponsor pre-filed testimony?
Yes, I did.
Do you adopt this? Do you have any changes to this testimony?
No, I do not.
Do you adopt this testimony as your sworn testimony here?
Yes, I do. Thanks.
Mr. Toronto, can you approach the mic and please state your full name and title for the record?
Jeffrey Toronto, Manager of Budgets and Investment Planning in Connecticut.
And in connection with this proceeding, did you sponsor pre-filed testimony?
Yes, I did.
Do you have any changes to that testimony?
Yes, I do.
What are those changes?
When we were preparing our filing for Monday, March 17th, we noticed the $3.8 million reconciling item between what we filed for 2024 capital additions. So our March 1st filing had capital additions that were $3.8 million too low. So those will be updated for the March 17th filing.
Thank you, Mr. Toronto. And with this updated testimony, do you adopt this testimony as your sworn testimony here today?
Yes, I do.
Thank you. And Ms. Purbeck, can you please state your name and title for the record? And in connection with this proceeding, did you sponsor responses to interrogatories?
Yes, I did.
And do you have any changes to these responses?
No, I do not.
And do you adopt these responses as your sworn testimony here today?
Yes, I do.
Thank you. Mr. Rice, can you please approach the mic and state your full name and title for the record?
Brian Rice, Director of Customer Solar Programs.
And in connection with this proceeding, did you sponsor responses to interrogatories?
I did.
Do you have any changes to those responses?
I do not.
Do you adopt these responses as your sworn testimony here today?
I do.
Thank you. Mr. Bruno, can you please stand up and state your name and title for the record?
Hi, good morning. Stephen Bruno, Director, Energy Efficiency.
And in connection with this proceeding, did you sponsor responses to interrogatories?
Yes, I did.
Did you have any changes to those responses?
No, I do not.
Did you adopt these responses as your sworn testimony here today?
Yes, I do.
Thank you. Mr. Matthews, can you please state your full name and title for the record?
Good morning, James Matthews, Manager, Transmission Rates and Revenue Requirements.
And in connection with this proceeding, did you sponsor pre-filed testimony in responses to interrogatories?
Yes, I did.
Do you have any changes to those materials?
No, I do not.
and you adopt these materials as your sworn testimony here today.
Yes, I do.
I'm going to skip over Mr. Bajan because he did not sponsor anything. And Ms. Gagliardi, can you please state your full name and title for the record?
Melissa Gagliardi. I'm the IT product line manager for the billing department.
And are you familiar with a response, interrogatory response sponsored by David Coco in this proceeding?
Yes,
And do you have any changes to that response?
I do not.
And you adopt this response as your sworn testimony here today?
Yes, I do.
Thank you. And with that, Connecticut Light and Power's panel is available for questioning.
Very good. Thank you. We will begin this morning with cross-examination by the authority staff. Mr. Arpin. Thank you.
Thank you, Madam Chair. Good morning. My name is Christopher Arpin, and I'm with authority staff. This morning, I will be handling questioning regarding the Systems Benefit Charge, or SBC. So my first question, could the company please clarify whether the low income discount rate IT capital requirement line item on page 2 of Exhibit H includes the company's $140,000 IT cost estimate for implementing a 5-tier LiDAR as stated in CAE 15? If not, please clarify how Eversource plans to recover its IT costs relating to the implementation of a 5-tier LiDAR.
The IT LIDR capital requirement in the exhibit you reference is the implementation of the 2-tier LIDR. The company is in the process of implementing a 5-tier LIDR this year. There's a decision expected on March 19th from Pura to finalize that. And then after that, we'll be implementing a 5-tier, which the cost will be in the SBC for next year.
Thank you for that response. So my next question, could the company please explain the 2024 low income discount rate IT capital revenue requirement cost about $800,000 and whether they're expected to decrease in 2025, given that the LiDAR is now operational? If a decrease is anticipated, please explain why the company did not file a known and measurable adjustment to this cost category.
So next year, that cost will increase with the implementation of the 5-tier LIDR from this year.
So those costs are recurring costs then, if I understand that correctly?
It's a recurring cost for 5 years for the asset.
Okay, thank you. So my next question, so the LiDAR draft decision issued on February 26 and docket number 171203 RE11 could, if adopted, immediately transition existing LiDAR customers to their eligible tier under the 5-tier LiDAR structure rather than requiring them to complete their current 12-month enrollment period. Please explain how this draft decision, if adopted as written, would impact the $119 million LiDAR Tier 5 cost estimate provided by Eversource in CAE 18. Additionally, please describe the broader effects of the LiDAR draft decision on the company's 2025 LiDAR cost.
So the decision or the draft decision, if accepted, the way that was written for customers who are self-identified as Tier 2, currently Tier 2 50%, where they provided the company with additional documentation to indicate that they qualify for that increased 50% discount. All those customers would remain on 50% until their expiration, because none of those customers were put on by the Department of Social Services list. For customers on Tier 1, currently 10%, a number of those customers will increase their tier from 10% to 15, 20, or 40, or even 50% based on the information that we'll receive from the Department of Social Services. And then there are a number of customers on that Tier 1 that will reduce their discount from the current 10% to 5%. Having said all that, we expect that cost that we put in, I believe it was CAE 18 of about 119 million to increase for 2025.
Okay, thank you for that response. Now switching to a different topic. So according to page 3 of Exhibit H, call handling expenses for ESS, RES, and LiDAR remain identical each month. Why don't these expenses fluctuate based on the actual number of calls received or the actual time spent explaining each program?
Good morning, I'm Bernie Budgeon. Good morning, I'm Bernie Budgeon. And to answer your question, I'm going to give you like different parts of that. So to address the same amount, that amount is calculated based on the increase in average handle time we see. And then at that average handle time is converted into a number of FTEs that we would need. And those FTEs are added to the program. Now, that average handle time remains constant in terms of whether the volume is up or down. We are sharing that information with all the customers that comes through. So those FTEs are added throughout the year for the entire year, and that's how we are dividing it on a monthly basis on a constant. The average handle time doesn't go up or down because of the volume goes up or down. Those FTEs are incremental.
Okay, thank you for that response. So why isn't the cost calculated based on the average handling time per month rather than across the whole year? Because I'm assuming that there would be some sort of variation in the number of full-time employees needed to explain the ESS and RES programs depending on the month.
So how we calculate is based on a time study. And for coming up with the cost, we did a time study of 380 approximately calls, randomly selected. And based on that time study, what we figured that there was an incremental 50 seconds attached to the average handle time needed to explain and discuss the RS and ESS programs. Now, those FTEs are added right at the beginning of the year to make sure that we are preparing for that discussion throughout the year. Yes, and we don't take those FTEs out. That stays constant, that anytime any customer comes in, we are going to share that information with them on every call that we're discussing.
Okay, thank you for that response. So now moving to a different topic here. So in CAE 42, the company reported recovering approximately $3.6 million for medical and hardship customers through legal collections at a cost of approximately $1 million. Given that the company can now resume legal collections following the final decision last fall on docket number 240501, does the company anticipate recovering a similar amount for medical and hardship customers in 2025? Why or why not?
So the dollars that we identified in CAE 42 indicate the collections that we had in 2019, the last year where we were actively doing legal collections for any type of customer. And we did restart legal collections shortly after the decision was made in November. But you can't expect the legal collections to be back up at the 2019 level. It takes time to get there, right? The legal process is very long in some cases, and it doesn't necessarily provide recoveries, a couple months after you start it. So there is kind of a ramp up to that. And additionally, some laws or rules have changed in the legal collections process, such as a Homestead Act in 2021, which increased the value of an equity of a house that is protected from legal collections, not just from utilities, but from any types of legal collections, increased to $500,000 for a married couple or $250,000 $100,000 in equity for a single person. And then additionally, there was an order in the November 6th, I believe, 240501 docket, which indicated that the company can move forward with wage garnishments, but for customers above 70% of the state median income, 75%, excuse me, of the state median income. So that limits the ability to use wage garnishments in the future. So all that said, we don't expect that level of legal collections to be impacted for 2025.
Okay, thank you for that response. So the follow-up on that, would the company recommend making a known and measurable adjustment for the SBC using an estimated financial and medical hardship collections figures? Why or why not?
No, we would not recommend that. We don't know in this new collections environment what recoveries would be had with just restarting legal collections. Will there be some? Yes. What that dollar amount is, we have no way to estimate accurately.
Okay, thank you for that response. Those are all my questions on the SBC. So that concludes my questioning. I thank the company for their time today.
Thank you and good morning, Madam Chair. Good morning, Commissioner Arcadi, Commissioner Karen. My name is Russ Bowman. I'm a staff attorney here with the authority. My questions this morning will be related to the calculation of carrying charges, the January to April known and measurable revenue adjustments being proposed by the company, LMPs, the calculation of known and measurable adjustments for certain renewable energy programs, alternative compliance payments, and the funding of FTEs related to grid modernization. So I believe that means Ms. Peruta, Mr. Shelnitz, Ms. Purbeck, and Mr. Rice.
You are correct.
All right, thank you and good morning to you all. I'd like to take them in that order. I'll start with carrying charges. For Ms. Peruta, Mr. Shelnitz, directing your attention to Eversource's March 3rd, 2025 RAM filing, specifically exhibits BB regarding the competitive transition assessment, the F on NBFMCC, exhibit G on the TAC, and exhibit H on the SBC. My question relates to page 3 of all of those exhibits regarding the calculation of carrying charges. So for those exhibits, B, B, F, G, and H, is it true that the beginning balance, i.e. the carry forward deferral balance used to calculate carrying charges would include prior year calculated carrying charge amounts?
Yes, that's correct.
And that beginning carry forward balance is then used to calculate an after-tax average monthly balance that in turn is used to calculate new carrying charges each month.
That's correct. It's also used to accumulate all the deferral activity that occurs in that new year. So that would also be the payment of the prior year's carrying charges that are built into the rate.
And just to confirm, based on the spreadsheets provided, the company does not roll each month's computed carrying charge into the next month's rolling deferral balance.
Correct. The current month's carrying charge is calculated and is just that's correct. It does not factor into the next month's balance until the end of the year.
Right. And at the end of the year, then the company sums each computed monthly carrying charge into the annual carrying charge, which is added to the end of year deferral balance brought forward into the next year.
And also used to set rates, correct.
Okay. So to the extent prior carrying charges are built into the balances that carry forward from year to year, it's true the company is effectively collecting a carrying charge interest that has a compounding effect.
It has an annual compounding effect, yes.
Right. So compounded annually, not monthly.
Correct.
All right. What's the company's rationale for this particular method of calculating the carrying charges?
Well, it's that's been the method that's been in effect for years in all of our reconciliation mechanisms. I mean, you can argue that, most financial institutions would calculate a monthly compounding, but for these rate mechanisms, we've been doing it annually.
And if I could just add, in addition to the fact that that's the precedent that's for practice in terms of the rationale for doing it, as Mr. Shelnitz just said, I think that's how it would be done in terms of calculating any carrying charge. It would be reflective of the total amount outstanding, inclusive of prior carrying charges. And also to note that it works reciprocally as well. So if there was an event where we were under-recovered or over-recovered, excuse me, having to return amounts owed to customers and accruing carrying charges that we're paying to customers, the same calculation would occur, such that we would be paying carrying charges as well on prior accrued carrying charges.
Right, so the calculation is the same, compounded annually and reciprocally, so in either direction.
Correct.
Okay, thank you. So switching then to the company's proposal to use known and measurable revenue adjustments to address the timing offset of the RAM docket's use of a prior calendar year proxy versus the May 1st implementation date for new RAM rates. In the company's January 15th known and measurable filing, Exhibit 1, which is the pre-filed testimony, pages 30 and 31, you all explained it this way. And any residual from the prior year's under or over recovery, i.e. the amount of previous December 31st under or over recovery that remains at December 31st of the current year before the final 4 months of revenue or refund from current rates for the period January 1st through April 30th is applied, is then included in the revenue requirement for the next rate change on May 1st. This can cause exaggerated increases or decreases between the rate periods where the rate in one period is artificially increased in the case of an under recovery or lowered in the case of an over recovery due to the remaining outstanding deferral balance from the prior year that is still being covered in current rates over the months of January through April. So all on the same page. So for example, at the end of 2022, the company reported a significant overcollection in the NBF MCC of approximately $234.5 million. Is it the company's view then that the NBF MCC was artificially lowered when setting the 2023 and then subsequent 2024 rates as a result of that overcollection deferral?
Yes, and that was a subject of much discussion in last year's RAM when there was a large increase in the rate that took effect on July 1st, 2024, exacerbated by exactly that fact. And we have tried, and we have comments going in today that are very much consistent with comments we've made in prior proceedings, whether it be in the active RAM proceedings each year since the process was changed, or last year on January 17th, we submitted comments in response to a PURA prompt asking, how to mitigate large rate shocks for customers. We also submitted last year on our February 15th testimony in the RAM proceeding recommendations to PURA that we think should be considered and still hope will be to improve the RAM rate making process, which is simply that the way the process was designed after it was redesigned after the 2020 rate changes, it was intended to remove entirely from the calculus any forecasts whatsoever. Forecasts at the time prior to the change were used in setting rates that changed twice a year if the forecast proved inaccurate. The updated process said do not use forecasts in any capacity, rely on the prior year actual revenues and expenses as adjusted for quote known and measurable changes, which has a very particular meaning to us. So we've been saying in these proceedings from the beginning, that is a very specific direction to us to use the prior year actuals as it relates to the revenues. One unintended consequence is that it exacerbates rate shock to the extent the prior year actuals are not a good predictor of the current year's forecast, because this is a perfect example this year for Eversource where we had the prior year calendar revenues, which following PURA's new process are on a 12-month calendar basis, right? If we use the revenues in setting rates, that would give us one answer. But we know that the actual revenues that had been put into effect on July and then again on September were collecting costs over a 10-month window. So had we forecast perfectly in rate making, in all of these rate makings, I always like to think of how should it work if we could forecast perfectly and nothing were to change. The problem with the current PURA process is that even if we had perfect forecasts in setting those July 1st, 2024 rates that were collecting costs over 10 months, and then September 1st, 2024 rates, which were collecting costs over 8 months, if we were forecasting perfectly, that would mean by the end of the 10-month or the 8-month window, we would be fully recovered and perfectly recovered. Revenues equal expenses, customers owe no and more, and we know owe more. But by cutting off at 12/31/2024, you're ignoring the fact that you have a rate that will stay in effect to collect the prior period under recovery. So a very long way of saying, yes, we do think that the process that has been used since PURA changed the RAM rate making process back after the 2020 RAM rate making year is flawed and is exacerbating rate shock to customers in either direction. And we're hopeful that we can come to a process that doesn't do that.
Thank you for that. You may have answered this question. I know the company is proposing that adjustment with respect to the NBFMCC and the SBC this year. Do I take it to be your testimony that that would be justified on an annual basis?
Well, my testimony is that the process holistically should be evaluated and updated. And I would argue that we should be using best available information and setting every single component of the RAM rate-making process. In some cases, we may argue, or the PURA may find, that using last year's actuals is the best proxy. Mr. Trainer was just testifying about a specific cost component that we're not able to forecast with great accuracy or confidence right now, so we may not want to put into rates a proxy or a bogey. But right now, we know that in many respects, relying on the prior year calendar year actual experience and setting the current year rates isn't a good proxy. It's causing there to be rate shock and rate whiplash is the term that we've used and that we've seen since the process was changed. So just holistically and across the board, I would say that we should be coming to a better process. One of those things would be just conceptually, if ever we're designing a reconciling rate to collect a cost over a certain amount of months, when we're setting that reconciling rate in the next period, we should be taking into account our estimated revenues and expenses for the period of time that that rate is going to remain in effect. Simply as it relates to the revenue calculus, the issue would be that we would be setting a rate, say, May 1st of 2025, if we didn't make a change here to the process. Setting a rate May 1st, 2025 to collect a dollar amount over the succeeding 12 calendar months. And again, if we were perfectly forecasting both the revenues and expenses over that time period, we would know that we would have a ill-informed rate next May 1st, 2026, when we come along and snap the chalk line at 12/31/2025 on the revenue side. Even if the expenses we got 100% right, that rate May 1, 2026 is going to be wrong because we're not going to have the full effect of the rate that we put into place on May 1, 2025. We will have 4 months, the first 4 months of the calendar year based on the prior year's RAM rate setting process, which again is not tied to the cost that we're reconciling to. So again, long answer to a short question. Yes, I think we should be looking at this, but not just at this one change in isolation. I think the whole process should be revamped. And that's what our comments today are saying and what we've said in prior comments that we've submitted. We should be looking at using the best available information, whether it's forecasts or the prior year actuals, and we should have an off-ramp to the extent that the forecast becomes out of alignment, especially as it relates to the purchase power agreements, which are tied to the market prices for electricity and have shown extreme volatility in the RAM rate making process.
And I do have some questions on that issue in a minute, but and I want to acknowledge that we have a separate docket on this very issue of 24/12/05 on the RAM process overall. So my next question may be more appropriate for that docket, but to the extent we're having the conversation, I'll ask it here anyway. Is the known and measurable adjustment that you're proposing the best way to get at this lag issue that you've identified? Or is there something else that you would recommend?
Well, I think, and my team can help me, the way that I would describe the known and measurable adjustment that we are proposing is we are trying to reflect in the revenue side of the equation, what is the differential in revenues for the period January 1 through April 30 of 2025, really as compared to that same period that we actually recovered in January 1 through April 30th of 2024. And we're factoring that in. So that conceptually what we're doing is saying, okay, again, all else equal, if we had perfect information and perfect forecasts at the end of April 2025, we will be fully recovered for the amounts that were put into rates over a 10 and 8-month period in 2024. So I think that is certainly has sound logic and reason to it. All we're trying to do, it's still imperfect to the extent that we don't know what the actual volumes will be over that time frame, and the revenues may prove to be more or less, but still better than assuming none.
And just to add to what Mr. Horton said, the known and measurable was an effort knowing that the under recovery was, so significant and certainly unprecedented. So the company made the effort to include that known and measurable in order to set rates on May 1 of 2025 so that we were not setting them too high. So we took the known and measurable as a measurement of the under recovery and did a forecast of what we expected the revenues to be based on the rate setting that happened in 240103. And so that is the forecasted revenue we included in our known and measurable. As Mr. Horton indicated, it is still an estimate because we do not know what the sales will be. So that was based on a forecast and is still subject to change.
Understood. Thank you both very much. And again, this may be better for 24-1205, the RAM process docket, but are there other methodologies that you would want to recommend Pure consider at this time?
Well, I think if you were, like in other jurisdictions, we have the same dynamic where we have public policy programs that flow through our rates on a reconciling basis. And generally, those rates are set to collect the cost of those programs on a concurrent basis, meaning as we're paying the expenditures, we are also recovering in rates the costs. So we're relying in those proceedings on a comprehensive forecast of both the revenues and expenses based on our sales volume projections. So again, I would argue that we should be looking at holistically what the best way to do that is so that if we have perfect information in that forecast, we get to a perfectly recovered balance by the end of the period to mitigate carrying charges in either direction for customers. It's hard to say, is there a better way to do this one specific item where we're trying to say the whole process should be revamped to have that conceptual basis. If we can forecast perfectly, we should have no over-under recovery in the rate-making framework. And right now, the framework doesn't do that, number one. And if that forecast is not going to be perfect, because only thing we know is it's not going to be perfect, we feel there really should be an off-ramp for customers if we're too far over-collected or too far under-collected, again, to mitigate future rate impacts and carrying costs in the public interest.
Understood. Thank you. And lastly, on this point, just directing your attention to the company's response to interrogatory CAE 029. I just want to make sure that the company proposed this as a known and measurable in this context, but it's the position that they weren't previously offered as a known and measurable because of the definition of known and measurable as you've testified, so that it wasn't previously viewed as a significant departure from prior year data, compounded by the uncertainty of some of the forecast sales and issues you've testified to.
That's right. This was obviously a large component. It was a significant factor of the increase that took place last summer. We designed a rate to collect the costs over a set period, and by not making this change, our view was we were going to be exacerbating the rate whiplash that customers would have seen by building a rate for May 1, 2025 that ignored revenues that we know we're going to collect to some level for the first 4 months of 2025. That would cause the rate to be artificially higher, causing us to have an artificially higher over recovery at the end of the period. And we just don't think that's wise to do. So we propose in this instance to reflect the known and measurable change. But again, and we've struggled with this and we've looked for guidance and tried to get guidance on what Pure would like us to do with known and measurable changes. Again, if we go back to the process that changed, the directive was in the rate increase that happened in 2020 came at a very unfortunate time and resulted in a lot of customer angst and outrage, which I remember and still have the scars from. So it was well-intentioned, but the idea of having that forecast be what caused the problem resulted in a new framework that doesn't allow us to use forecasts. So we read it to take out all discretion or estimation from the process entirely. We know that the sales volumes over the first 4 months are going to be something. We can have a forecast, but that forecast is not going to be accurate. It's going to be off just because the nature of forecasting. So all I would say is from the beginning, we've been trying to adhere to Pure's directives in this process, which in our read didn't accommodate that. In this case, given the magnitude, we felt that it was the right thing to do for customers. And while we're also now 4 years of experience with this new process, we feel passionately, or I do as a rate-making wonk, that we should be updating the process. And if, in absence of a change to the overall framework, the only tool that we have in our disposal to follow PIRA's process and directives is to rely on known and measurable changes, even if that's a forecast.
And it is true that the PIRA decisions have said that even where it may not be technically or strictly known and measurable, if the company should provide information if there's a potential for a significant disparity, and that is then tracked throughout the entirety of the RAM proceeding.
Yeah, exactly. And I think this is where, again, perhaps it's just a misreading of the tea leaves or what have you, but that standard, known and measurable, has a particular meaning to us. We're applying, it sounds like, and we've, you know, we've had conversations in the RAM docket since the process was changed. I personally have asked, help me, help you type of thing. I don't know, I can't read your mind. On the one hand, saying known and measurable changes in this application is okay to rely on a forecast, and we should. Whereas we know in rate case decisions, if we include a forecast, that's not truly known and measurable. It's unlikely to be accepted in a rate case proceeding. So we're really trying to understand what's the best way to go. I'm hearing that, you know, through the questions, and not just from you, Attorney Bowman, in prior, you know, RAM proceedings too, we would get similar questions asking to the effect of, well, why didn't you include X, Y, or Z, which to me sounds more like a forecast as compared to a quote unquote known and measurable change. Bottom line, from my perspective, I just want to get it right. I think it makes sense to have a process that relies on forecasts, that gets us to a place that if everything happens as we think it would, we have no over or under recovery. We minimize rate shock to customers. We minimize overall cost to customers. I'm happy if we can do that, whether we call it a known and measurable change or a forecast or what have you. I think we should be relying on the best available information and having off ramps if things get out of whack one way or another.
Fair enough. Look forward to the input in the process docket 24-1205, and certainly appreciate the conversation today.
Likewise, thank you.
With that, my next series of questions is concerning the effects, some of the volatility we've heard about today, and locational marginal pricing on the power purchase agreements that are within the NBF MCC. So I think this is for Ms. Purbeck. Directing your attention to CA 030 on this issue. So you'd indicated that a partially actualized LMP forecast, and there is that word forecast, but that was partially actualized in that it accounted for the actual January and February LMPs. If that partially actualized forecast were to materialize for 2025, the updated projected total revenue impact on the PPAs within NBF MCC would be a net benefit of approximately $135 million. Is that correct?
Correct.
All right. So to clarify, is that $135 million of potential extra revenue that the company estimates representative of additional incremental increase that the company could expect in 2025 when compared with revenues from PPAs in 2024?
I believe we provided that in response to a different question. Potentially OCC 16. So the question is the $135 million that's projected if the actual LMP forecast were to materialize in 2025, if that's an incremental cost as compared to, I'm sorry, can you repeat?
So is it incremental that from what in 2025 from compared to revenues from 2024?
No,
Okay.
that's just a 2025 number. So in 2024, I believe the cost of the PPAs was roughly $74 million. So this would be a net benefit of $135 million.
All right. So let me ask it a different way. If all other things being equal in the NBF MCC, if all other things were equal, and the updated, that is partially actualized LMP forecast came to fruition, is that $135 million something that is not otherwise factored into the current May 1st rate proposal?
That's correct. That has not been factored into the May 1 rates. Correct. What has been factored into the May 1 rates as of, our known and measurable filing, we included in our known and measurable comfortable filing a section describing the LMPs, but we did not propose any type of known and measurable. What we did indicate, as Mr. Horton said, and as you indicated, is that we would continue to update the LMPs throughout this proceeding. And then we also provided a promise in our discovery that by April 15th, we would give the latest information so that the commissioners can make a decision on how to treat that in the May 1 rate setting process.
And just building up upon that and repetitive a bit to what I was saying before, I mean, the PPAs are the largest, generally, single biggest mover in these, and we've seen in recent years they can move significantly in one direction or another. So the comments that are going in today and that we said last year, our RAM filing and those comments we filed last year, will say the same thing. We think it's appropriate to include the latest available information. As it relates to the PPAs, it's the winter months that are the most volatile. So it's not to suggest that once we get through those, we know with certainty what the final, calendar year 2025 expense or benefit will be, but we'll have much more closer because we'll be past January, February, March, April, or January, February, March at least, that are more volatile. So we hope that PURA would incorporate into its process the latest available information. So our intent is to provide actual and estimates through the March period by approximately April 15th in time to get reflected in the May 1st rates. This year, if all else holds, and we should all knock on wood, it would be a benefit to customers that's not currently reflected in rates. We think that it should be put into rates, but again, it doesn't make sense in my mind to do things like this holistically, whether we're talking about the revenue adjustment or on this expense side for the PPAs, because there's still things that can happen through the course of the year that get us out of whack, especially with the PPAs. So we would hope as well that if we do put that into rates, there's an off-ramp for customers. If the costs go up or down, that rates can change on a more real-time basis to avoid wild swings in rates in the future and the associated carrying costs that come with it.
Thank you both. To the extent there's a forecast component in some of this, can you comment on the company's perspective as the main drivers in LMP prices and the anticipated increases thereof?
LMPs are generally, for the most part, driven by the weather, and colder temperatures tend to result in higher LMP prices, and as well as the price of natural gas.
So does that comport with what you're seeing in the wholesale market currently?
I would say so, yes.
Has the company ever performed any kind of historical analysis as to the projections that you used versus what actually happens, and how, if at all, does that get incorporated into the process?
Yes, so we have done that, and in last year's docket number 240103, we provided 2024 projections, and we also updated them with actuals, and then actuals from January and February, and projections for the rest of the year. And the difference was pretty dramatic. So the projections at the end of 2023, projecting for all of 2024, would have resulted in a $16 million credit to customers. Updating that for just January and February, to pull on Doug's point earlier, updating the actuals for January and February of 2024, and then reprojecting out in the end of February for the rest of the year, that changed to a net cost of $65 million. And then the ultimate result was roughly $74 million. So the $65 million, just inclusive of the January and February, ended up being much closer to the actual costs that happened last year in 2024.
And I think if we go back, and Ms. Purbeck maybe have to help me with this, but if we go back to the 2022 year, we did see a similar significant swing and change in a very short time frame. So in calendar 2022, the PPAs were producing a benefit to customers that turned around in a significant way to result in a cost in the following year. And that happened, or we saw that start to happen over a very short window in January of 2023, sort of right before our eyes, which is why we think it makes sense to do two things as it relates to the PPAs. Lock in a rate once we get through those volatile winter months, because it can change by the week or by the day in a very significant way. Get through those volatile winter months, but then still have some out or some off ramp to the extent, again, market conditions change, which they can, and of course, none of us can control. If the natural gas market gets disrupted for whatever reason and has significant impacts on LMPs or weather or any of the factors that drive it.
Understood. Thank you very much. So next, I'd like to shift and explore the calculation of some other known and measurable adjustments. These are related to certain renewable energy programs, specifically LREC, ZREC, SCEF, and NRES. So I think that's Mr. Rice. Good morning.
Morning.
Exhibit 15 to the company's January 15th known and measurable filing provided calculations for known and measurable adjustments based in part on incentive payments. Values are associated with the LREC, ZREC projects, correct?
Correct.
And those incentive payments assumed the associated projects met 100% of their maximum annual quantity, correct?
Correct.
All right. And then the information in response to CA 33 indicated only 11% of the LREC, ZREC projects actually produced their full or better MAQ. And then in the most recent contract years, the total of all LREC, ZREC projects produced 80% of the aggregate MAQ. Is that correct?
Correct.
All right. So is the company comfortable with utilizing the updated figures for a known and measurable adjustment with projected incentive payments costs taking into account that average 80% MAQ as shown within the attachments you provided in that interrogatory?
Yeah, I believe the company's comfortable updating the assumptions used for the 2025 forecast of our ZREC incentive costs. I don't need to be that close, excuse me. With the expectation that in the event of actual costs exceeding the forecast, that those would be captured in a future reconciliation.
Sure. That being the case, would applying an 80% of MAQ factor be appropriate for SCEF and NRES for known and adjustments with respect to those programs?
The company hasn't done any analysis to answer that question.
Is that something you could supplement the CA 33 to provide that same analysis with respect to SCEF and NRES?
We could. I'll just caveat that we'll be working with a much smaller sample size with NRES and SCEF.
Thank you. All right. I'd like to shift to alternate compliance payments. So in regards to the ACPs that are within the NBFMCC, the company had noted, I believe, 8,031,409 in credits received in 2024. Can you just walk us through where that specific figure comes from? And that's Exhibit F, page 3, line 41. Also mentioned in the pre-filed testimony on page 25.
So those would be the actual credits received from energy suppliers in the market who in the annual RPS docket are determined to owe an alternative compliance payment. And so it's usually the prior year's RPS docket that amount is derived from, but it will be the actual payments received from the energy suppliers.
So in light of the fact that the RPS docket was decided this week in 240601, are there any additional credits the company is expecting that might justify a known and measurable adjustment?
No, our history has been that some suppliers don't pay their RPS on a timely basis. So no, there would not be known and measurable for the RPS docket that just concluded. We'd have to wait and see what the energy suppliers actually pay before knowing the amount of any credit that could be put into rates.
All right, thank you. And now a final question for me on FTEs. And this is in reference to the company's January 15th known and measurable filing, Exhibit 1, is the pre-filed testimony, page 81, Table 2. And the company confirmed that the 31 projected FTEs included within the NBF MCC and grid modernization and clean energy programs are not being recouped within base distribution rates.
Hi, Steve Bruno from the Energy Efficiency, Director of Energy Efficiency. The grid mod programs for the IES, EV, and ESS, those are not in base rates. So those are separate incremental employees.
Okay, thank you. And again, thank you all. That's all the questions for my part. I believe my colleague, Mr. White, may have one.
Thanks, Chris. If we could refer to I'm talking about NBF MCC IES. And if we could refer to Exhibit 21.
So if this is going to be a deep dive into the IES.
I don't think so. It's
Okay.
one specific question.
Okay.
I just want him to be able to see what
Okay.
what exactly I'm asking about.
Sure.
Cell 020. I don't know if you, my question is about the labor and third-party support. And what does the annual total of 1.456 million comprise?
Oh, sure. Thank you. So the 1.46 is a combination of internal FTEs to support the program, third-party vendors to do analysis, and additionally, it's marketing efforts as well.
Okay, so I just wanted to hopefully attach some numbers to those.
Sure.
So, FTEs, when I was looking through the materials, it was maybe 3 FTEs.
Yeah, about 2.4.
Okay, so what's the cost of that?
I believe for that number is about roughly $400,000 in FTE costs.
Okay.
And then there were different costs for third party, but we can do a supplement if you like, if we didn't put that in there.
Yeah, sure, if you could do that. But if you could even just talk me through it a little bit, just like in increments of $100,000 or even bigger than that. You said 400,000 for the FTEs, and then you mentioned third-party consultants. Is that a contract that sort of runs through Pura, or is there additional?
Yeah, sorry, the Stratagen company that does the main program management. It's a separate purchase order, it's a separate contract through Pura.
Okay.
So that's paid separately. These are third-party independent companies to help review some of the proposals as well. So technical consultants as the projects come through that the companies hire.
Got it. Okay. So that as well as marketing, basically, I mean, I know the program, which is you're trying to
the
get those
program on the
100
website
customers who
as
have
well.
heat pumps or EVs
Exactly.
in the door, something along, okay. All right. Yeah, if you, I think, she gives supplement.
But if you, honestly, if you do want a late file, I'll be happy to break out the 1.4, but high level is 400,000 for FTEs to run the program, or 400,000 budgeted for third-party support, and then some marketing costs.
Okay. Yeah, that's fine. Thank you. Thank you. And that's it for me.
Okay.
Thanks.
Morning, Tom Wheel for the Office of Consumer Counsel. I was thinking it'd be cool if we got like rotating, like if we could just like automatically rotate in after during these hearings. That'd be, some sort of mechanized table. That'd be good.
We'll make an appropriations request.
Thank you. My first questions are about OCC 10, which was sponsored by Mr. Shelnitz, and Ms. Peruta. Okay. I see in the response, it says, accordingly, the company does not attribute revenue collections to individual cost components. And I understood the explanation there. And I understand that to essentially mean that the company is not able to itemize under recoveries on a program level basis. Is that accurate?
That is correct.
Okay. But the response also includes this statement explaining that the NBFMCC under recovery in 2023 was attributable to the under recovery of purchase power agreement costs. So can you explain the difference in those concepts between attributing revenue collections to cost components versus attributing under recoveries to a particular category of costs?
I can start and then my colleagues will fill in. I think we'll understand where you're trying to get in to be able to break it out. Our point is we can't with specificity because we have just one rate. That rate includes, as was prior questions, it includes, for instance, prior period under collections. There's carrying costs from prior periods. We have a single rate in a single pool of revenues, as opposed to however many components there are in the NBFMCC. It isn't that we have, a revenue stream associated with each. So to get very granular, you lose the granularity fairly quickly. Money is fungible, so it's not going to any. However, certainly we're able to get close and we're able to make assumptions and assertions around, well, what changed versus the forecast. Again, if the rate collected exactly what it was supposed to and the expenses materialized as exactly as was built into the rate, then you wouldn't have an under recovery. In this example, we know that the rate was designed to collect or actually to provide a benefit that was materially lower than the actual net cost that customers ended up paying, to the tune of hundreds of millions of dollars. We wrote the checks, we paid them out. It was a very large driver of an under recovery. And so you're certainly able to see that the under recovery was driven in large part by that one single factor. But to get into like the prior balance under recovery, you lose the specificity fairly quickly.
Okay, thanks. And just to make sure I totally get it, I'm hoping we can open Exhibit F for this year's filing from the May 3rd filing. And I'm going to use tab 3. I'm going to use line 38, the NCQF, as just an example to ask some questions about. So the 2024 cost for the NCQF is $132 million. And it's possible to take that $132 million and compare it to the total 2024 incurred cost of about $375 million. You could calculate that and you could, with precision, determine the proportion of the incurred costs, not the under recovery, but the incurred 2024 costs attributable to NCQF to be like 35%. Is that right?
That is correct. Yes. If you set aside any over or under recoveries, that is exactly how we would impute the costs and the associated rates. Correct.
Okay. And the reason I chose NCQF is because there was an under recovery in that line item, meaning, I'll back up a little. That line item cost more in 2024 than it did in 2023 by about $11 million, right?
That's correct. Yes.
Okay. And the reason I didn't especially classify that as an under recovery is that it's my understanding that Exhibit F, just like other similar exhibits, H, G, doesn't capture known and measurable adjustments to prior years. So that would be a factor in determining for sure whether there was a rate level under recovery for any given line item, right?
Correct. That's why I hesitated, because there was a known and measurable last year. So it can be deceiving to just look at the schedule because it does not take into consideration the rate building that occurred in prior year with the known and measurable. And in addition to that, the over under recoveries. But again, looking at it just on its face, when you look at costs that are captured within the different rate components, this would be a good place to start with for sure.
Okay. So would it be correct to say conceptually that the NCQF's contribution to the proposed increase to the May 1st NBFMCC in this case is driven both by its 2024 actual cost as well as any contribution to the under recovery that is a factor in the May 1st rate request? In other words, if I asked you how much of this May 1st rate adjustment is because of the NCQF, would you have to look at both the 2024 actual costs and also consider the contribution of the NCQF to the under recovery?
You would, and you would also have to take into consideration the known and measurable that was built into the rate setting last year, correct?
Yes.
In order to determine the total over under recovery that is associated with that specific cost component. That's when it becomes overly complicated.
Right. So if I were to ask you specifically what percentage of the proposed May 1st, 2025 increase to NBFMCC is because of NCQF, you couldn't give me a percentage number. Is that correct?
Not based on this page, no. We would have to do a calculation, correct?
And how would you do that calculation? Like, how would that calculation parse out the proportion of the under recovery in the NBFMCC that's attributable to NCQF?
We do not break it down to that level of detail. We just wouldn't be able to. Again, as Mr. Horton indicated, the revenue is fungible. Then you have changes in sales forecasts you'd have to take into consideration. It just sort of becomes a pool of revenue. We would be making some assumptions. In the case of, for example, last year, when we had a rate setting process in 2023 that created a significant under recovery associated with certain decision making. We made pretty certain assumptions on what that under recovery related to in terms of the PPA under recoveries. But had there not been a scenario like that, for example, had the under recovery been as a result of some sort of, world geopolitical issue that created a significant swing across all costs, we wouldn't be able to tag that to any specific line item.
And I would just add, I think, because it is tricky to speak in absolutes. I mean, we can do anything. We can evaluate anything. If you had a single cost and a single rate, so that it was $10 million we're trying to collect, and we design a rate to collect $10 million, certainly it's much easier for us to say, okay, well, the actual expense was $9 million, therefore we were under recovered by $1 million. But if the actual revenues were also just happened to be lower, so there were, so you get into a very difficult explanation. And when we have 50 plus line items, our point is it does become difficult to evaluate each one when you have one revenue stream. It's affected by sales volumes, which are affected by a number of different things, rates changing on different dates, the period of time, like we talked about earlier, that the revenues we're using to calculate. You could do a calculation, I think, as what you're asking. It's just that it would be false precision in some respects, and it would be extremely complicated because you're going to have things moving in opposite directions.
Yeah. Yes. Sorry to interrupt.
You had asked, so how would you do it? I think the way you would do it is you would try to go line by line and say, okay, what did we put into rates as an expense, taking into account known and measurable changes in actual expenses that were built into the numerator in the calculus? What were the actual expenses, and compare the two? That would tell you the difference in expense between each given period. And then you would have to do the same thing on the revenue side by saying, essentially, if volumes worked out exactly as we had forecast, and then there's a piece of the over under recovery that's attributable to forecasting volatility in there. It does become, though, again, after that next year, now you've got just a one pool of over under recovery in any given point in time. It's comprised of all these different individual calculations that then get spread and pancaked across the whole year. It it just gets hard year over year over year. But when you have the large swings for one reason or another, it's obviously a lot easier to explain, especially to customers.
Understood. So, I mean, but in order to do that exercise, you would at some point have to engage in like the fictional practice of essentially saying for every dollar of revenue, this dollar went to this line item. And this dollar, and that line item might have actually been a credit mixed into an overall under recovery. So you have to kind of account for every dollar, like where of revenue, what contribution that dollar had to any piece. And then even that you'd run into, that's still based on assumptions because you could break it down to you could break it down to every cent, right? Like I mean, am I correct that like ultimately, like there isn't any way to be 100% correct unless, and I'm not suggesting this by any means, but unless you set up bills so that there was literally a rate for every single line item within, for instance, the NBFMCC.
Yeah, and then you'd have like a rate for every individual over or under recovery line item, each one of that. Yes, exactly, which is our point. It's not that we don't account for it. Well, we don't account for it that way, to be clear. So that's why when we're answering, we're saying we can't do it because we don't do it that way. But you could certainly undertake an analysis to try to do exactly what you're saying. You'd basically say, what were our actual expenses? What did the overall rate, how much did the actual expense go into for each line item? What was the expense that went into calculating that rate? But that rate includes, again, the accumulation of all prior periods, carrying charges on all prior over under recoveries. So you could do an exercise, but it's just false precision, and it's not how we account for it, which is why we didn't just give you a nice, pretty spreadsheet.
Okay, thank you. I'm going to move on to some questions about NCQF more substantively. So I'm going to start with the response to OCC 12. Which was, that one's missing a witness, which is fine. I was just trying to, Mr. Rice is coming in. See. So just for kind of background, we had originally issued an interrogatory request asking for the company to provide like a line item cost driver analysis for the NBFMCC. The company's initial response provided essentially the same information that was in Exhibit F for the related year. But then similar to the discussion we were just having, well, somewhat similar, we asked a follow-up interrogatory, which is OCC 12, asking, does the line item, for instance, for the RRES program that was provided in response to OCC 2 account for bill credits? And my understanding from the response was that that number did not account for the bill credits that are driven by the RRES program. Is that correct?
That's correct.
Okay. And OCC 12 also asked for based on our understanding that those bill credits were accounted for in the NCQF, which is a separate line item in the NBFMCC, for a program level breakdown of those bill credits. And my understanding of this response is that the company can make kind of estimates based on billing system amounts, but doesn't account for program driven line proportions of the NCQF. Is that correct?
Not entirely. So in response to OCC 12, it further itemized the portion of NCQF associated with bill credits through the company's C2 billing system. So that's why C2 is used. And of the 110,391,791 of 2023 bill credits, 13.2 million of that was associated with RRES and NRES. And both, and those are identified based on what's referred to as a service plan, which is a code in the company's billing system. So at this time, we have queries that allow us to identify bill credits by what service plan they're on. And since the operation of the netting mechanism for the RRES and NRES programs is the same, they utilize the same service plan. So we could identify the bill credits associated with the new programs and distinguish those from legacy rider and virtual net metering.
Okay, but if I were to ask you how much in the NCQF is driven by NRES specifically and not RRES, could you give me a number and your response to that?
Not at this time. The company actually is in the process of updating our C2 queries so that we'd be able to isolate those in the future.
Okay. Thank you. I want to turn to Exhibit F20 from the March filing, which is the NCQF specific exhibit. And I'm looking at tab 3, which is page 2. Can I just back up 1 second, Mr. Rice? Do you know when you mentioned that that you are making updates to the C2 billing system? Do you know when those updates are going to be live?
We're not making updates to the billing system. We're making updates to the queries that are programmed out of the system.
And do you know when those updates are going to be operational?
Relatively soon. I know, yeah, our IT department is actively working on it.
Okay. Thanks. So turning back to Exhibit F, page 2, tab 3, I just had a question about some of these line items. So I noticed in the response to OCC 12 that the line items marked solar under the fuel type column, which is column B, are generally the behind the meter solar program costs. Is that correct?
I'm sorry, which exhibit?
In response to, sorry, I'm looking at Exhibit F 20, which is the NCQF specific spreadsheet.
I'm sorry, what column, Attorney Wheel?
Column,
On page 2?
I'll back up a little. Looking at, I don't mean to mix you up, but the response to OCC 12, response B on OCC 12, which is on page 2, references, it says, it's actually referencing the NCQF filing from last year's docket, but it says that actual costs with a fuel, quote unquote, fuel type labeled, quote unquote, solar in rows 24 through 27 in that exhibit constitute the on-bill credit costs for solar facilities through RRES and NRES and legacy programs. So I'm just asking, I guess my question is that also true of this exhibit that was filed in this docket, that those fuel type labeled solar numbers, the numbers associated with column B labeled solar are the behind the meter solar programs?
Yes, that's generally true.
Okay. There are other line items in this exhibit I was just curious about. Do you know, so row 11 says fuel type diesel, technology type internal combustion engine. Do you know what that is? Like what is that a project, or can you tell me anything about that?
I can't. I don't think any of the current panelists can, but maybe if we give us a minute to confer with other witnesses in the room.
Sure. I had some other questions about what these are. So maybe it would be more efficient to just ask if it'd be possible to supplement this exhibit with a narrative explaining what all these line items are, like in just a narrative language.
I just want to make sure I understand the request. You're looking to have every single line item described as far as what?
Yeah, I'm looking for a narrative that just says, for instance, using row 10, fuel type biofuel, technology type internal combustion engine, just a general narrative saying like what in the real world is out there that's driving these costs. Sort of like if there's a project somewhere that is a internal combustion engine running on biofuel, like where is that? What program is it? How do these costs end up in bills? Does that make sense? Yeah.
Attorney Wheel, is it okay if we speak amongst the witnesses, maybe on break, to determine if we can break this down any further? Just so you know, the information that is pulled on this schedule comes from Eversource's billing system already. This is the report that was prepared in order for the company to provide this level of detail and information. We just don't know whether or not we can break it down any further or be able to link it to any specific customer and any in a timeline available for us to provide it relatively quickly, because of the number of customers that this is obviously linking back to in the billing system. So if you wouldn't mind, Attorney Wheel, could we reconvene it after?
Sure, absolutely. And to be clear, I'm not looking for a 5,000-page spreadsheet showing every single customer. I mean, I'm aware, for instance, for like the solar line items, I'm not looking for every address. We have that information in like the RRES dockets. But first, for instance, a narrative for the RRES would just be describing, these are costs associated with behind the meter residential solar through the RRES program, or the narrative for the fuel oil PV might just be describing like what kind of projects are being accounted for in here and why. But yes, totally. You confer over the break. Makes sense. Thanks.
Okay, thank you.
The last question I had about this exhibit, which might also require some conferencing, is whether it would be possible to provide an analysis of the rate class, presuming to the extent these costs are driven by bill credits, to show us a breakdown of what rate class those bill credits are being applied to on a line item basis.
I subject to seeing the current queries. I think it's just a matter of if our current queries have rate class in them, which they may, then that's a summary that could probably be produced. If not, then it would be more challenging.
And we've summoned our Director of Rates to see if he believes we can.
Hi, good morning, Ed Davis. So I think what we probably should be able to readily do is identify the categories and the rate classes that the different resources are on. I don't know if we can directly tie them to the bill credits per se, but I think that'll give you an alignment and a relative magnitude of which resource is tied to which rate class. Then we can further discuss the earlier question as well.
Thanks. And Mr. Davis, I can just clarify, the reason we're curious, I'm sure you can understand, is we're just curious about basic cost causation principles. These are bill credits going to particular customers. And it's our assumption that because the NCQF is flowing through the NBF MCC, which is in and of itself just subject to an allocation factor, we're just curious about, and obviously this is a conversation broader, probably better for the other docket, but we're curious about the contributions of particular rate classes to this particular category of costs. So that's the reason we're asking, if that helps to kind of address the question.
Certainly, and maybe to help inform that further, for example, you mentioned, I heard the C2 and PV related, which being a very large part of these. Those are often volumetric type rates with customers who are typically on more of a residential class rate. So that we can probably give you an order of magnitude of proportions. And then you can see from there what the cost drivers are for the credits, if you will. Use the word cost drivers in quotes. In other words, what prices and what's the nature of the prices and which rate classes they originate from that relates to the actual credits that we're reporting for a given period.
Yeah, that would be fantastic. Thank you. My last question on the issue of the NCQF response, it relates to an answer interrogatory response to OCC 23, which was sponsored by my former mentor, Mr. David Thompson. We framed the question seeking calculations for what we're looking for essentially was whether there are any other cost drivers for behind the meter programs, particularly billing credits that aren't captured by the NCQF. I'll take credit for drafting this response. I think I used the wrong terminology. I referred to it as missing revenue, and the response from the company expresses that it's not entirely clear what missing revenue refers to. And that just prompted some questions for me to make sure I understand. When a billing credit, when a company incurs a cost of a billing credit, isn't mechanically what's happening, that the customer to whom that billing credit is going is essentially just not contributing that equivalent revenue to the company?
I'm not sure I understand the question, what you mean by billing credit. Are you referring to a PV customer that gets some sort of credit on their bill? Is that what you're referring to?
Yeah, so that's a good example. A behind the meter solar customer enrolled in, say, the RRES program, they generate 100 kilowatt hours of solar. They receive a credit of 100 kilowatt hours worth of the value of that 100 kilowatt hours pursuant to whatever the tariff terms are on their bill. That imposes a cost to the company, and it's my understanding that that cost comes in the form of, well, that's money that now the company isn't recovering from that customer because it's being accredited against their account, but the company nonetheless incurs the costs associated with that credit. Am I misunderstanding that?
In order for there to be a credit, you would also have to satisfy the customer's consumption needs prior to that. So that credit would be the excess generation. So there are different buckets, if you want to call it that needs to be looked at individually.
Right. So, I mean, more simply, let's say that I'm a solar customer, I get a $10 credit because of my solar generation. That means that to the extent I later pull energy from Eversource's grid, that's $10 I would otherwise have to pay for my electric bill absent that $10 credit, right?
There, again, the amount of energy that you use while you're generating, and then to have an excess. But if you're saying that you're using at a time that you're not generating, and then you get a credit, that's a different computation, so to speak.
Yeah, I understand that. I guess I'm just making sure I understand. It seems to me that, like, in the aggregate, the reason this costs money, the reason that a bill credit costs money to Eversource is that that's the same amount of money Eversource is not otherwise collecting from customers. So that's missing money that isn't fulfilling the company's revenue requirement. Is that correct?
It's the purchased, sorry, Mr.
No, go
Manager,
ahead.
if you wouldn't mind.
Go ahead, Marissa.
So the net metering credits that are flowing through the NCQF, as we see in the MBF MCC, that's the actual purchased power. So that's above and beyond, right, what would have been used by the customer. And it's the excess generation that flows back into the system. So if you think about it as purchased power, that is a cost that the company incurs because it's giving, in your example, Attorney Wheel, the $10 back to the customer. Now, if the customer uses that, it actually flows back, right? Because that customer is using that credit in the following month, for example. So the net credits are a bit ebb and flow. The only amount that ultimately does flow through the NCQF is the obligation that is credited to the customer. Correct.
Understood. So the company is purchasing solar power in our example from the customer. Is the company getting an offsetting revenue for the value of that energy? Is it for like for a PPA, like Millstone, for example, purchase from Millstone, resell, there's offsetting revenue. Does that happen for behind the meter solar
We
programs?
do not sell the solar that's purchased, no,
Okay.
we do not.
So as a result, then the company is out that $10, right? The company is purchasing energy for $10. And then the company needs to recover the full cost of that $10 because there is no offsetting revenue. Am I understanding that correctly?
I believe that that's in accordance with a net metering tariff
Yep.
for, on the net metering and on the RS NRES, I believe, again, Mr. Rice, if you can confirm, that is
Yeah,
in accordance with our RS NRES tariff.
yeah, that's correct with respect to the cash costs that, the company is responsible for. We provide that bill credit to a customer and we're not monetizing anything associated with that could be utilized to, offset direct costs. What is happening is that power is being fed back onto the grid as a load reduction, and it's reducing the wholesale load that would otherwise need to be, supplied by all load serving entities.
Understood. To be clear, I'm not suggesting there is no value or benefit. I was specifically just asking whether there was offsetting revenues, but thank you for that response. Okay, and just to clarify, if I were to ask the total cost of, for instance, I'll stop picking on RES, for instance, LREC, ZREC, would I be able to see that by combining the line item costs that's recorded for that within Exhibit F, the NBFMCC, and then also conceptually the proportion of the NCQF that's driven by that program? Is there anywhere else I could see? Does that program create a cost impact than anywhere else on the company's books?
The structure is similar. I'll just clarify. So the LREC ZREC program was a standalone renewable incentive program. So it was just a program for the purchase of RECs. So there are actually no bill credits that are officially part of the LREC ZREC program. In practice, the significant majority of projects participated in LREC ZREC were also net metering through Rider N. So
okay.
That's where those would show up.
Okay, thank you. I'm going to move on to, I have a couple questions about OCC 7, which was sponsored by Mr. Shelnitz and Ms. Peruta. I have a similar question about this response as I just had about the NCQF exhibit, which is, so this response provides a list of capital projects, capital investments that are being recovered through the NBFMCC or SBC. What are these? I mean, I see that the description is like DER portal through a particular docket, or for instance, Connecticut residential solar tariff. Can the company describe like what exactly these investments are?
So the first two, the DR portal and DR map, were as it shows, were two projects that were approved to go forward under a grid modernization pilots that were in that docket 170602. I can't tell you specifically what they are. I think they were to allow people who are in. So the first one, the portal, I think it was for entities that were interested in doing a distributed energy resource to see if they were eligible in some fashion. I don't know if it was for the connection to the grid or whatever. And the similar is what the DER map was. It was supposed to help determine if a distributed energy resource was going to be viable in a particular place. And again, those were pilots. And those were the capital that was invested to make those two pilots happen. The SCEF, I believe, was billing system changes that were required. So those are capital additions to the billing system for the SCEF program. And the same thing with the Connecticut residential solar tariff and the LIDAR. the low-income discount rate. Those were for billing system changes that were necessitated by those programs.
Okay, thank you. Do you know if, I presume that like, particularly for the line items where there's a docket number identified, I presume that those dockets, that there's some information in those dockets about the expected cost of these investments. Do you know if there's any documentation of whether whether the actual investment levels coincide with those authorized costs, or whether those costs were ever technically authorized?
Well, the DR portal and DR map, like I mentioned, those were I think there were 10 or 12 pilot programs that were proposed, and these were 2 that were selected based on the costs of those pilots, and what they were going to provide, the service they were going to provide in respect to, like I said, I believe grid modernization. So that I can't tell you specifically if there were cost proposals in there, but I would assume that there was, because like I said, they did look at them and select. There were 12 that were proposed, and these were 2 that were selected. So I think the selection process probably took cost proposals into account.
Okay. Thank you.
And then I think the other 3, I do believe, those were, at the time those programs were being proposed, the company did inform that there were going to need to be billing system changes that were needed. And I believe that there were requests as to what those dollar amounts were going to be. And they should be in the records of those dockets.
Okay. Thank you. I'm going to move on to some questions about OCC 13, attachment 1, which was a follow-up interrogatory request to this OCC 7. My first question is just looking at row 19, comparing it to row 29, and the depreciation expense column. I think my question is the reason that the LiDAR IT capital depreciation expenses has multiplied from one rate period to the next? Is that because well, do you know why that is?
I am so sorry. Fighting a head cold here. So in the July 2024 rates, that was the 2023 costs. If you remember, LiDAR went into effect in December of 2023. So those IT capital projects were essentially placed in service at the end of 2023. We actually had this conversation last year in 24-103, and the ask of the company was, are those costs going to increase? And the response was correct, because the amount that was included in the rates was the 1-month amount. And this year you have a full 12-month amount.
Thank you. I was going to ask that's what I was going to ask, but I figured I'd let you confirm that. And that's similar conceptually to the LiDAR discount itself, right? Like the last year we had this discussion where the actual incurred LiDAR costs were de minimis in comparison to the expected cost. That's why we had $100 million known and measurable adjustment. Same reason for this growth and depreciation expense for this capital investment.
That's correct, yes.
Okay, thank you. I also noticed that every other of these investments other than LiDAR IT capital, if I look at the total column, which is the total revenue impact, that's declining from one year to the next. Is that generally because those assets are depreciating?
Yes, that is correct. So for example, DER portal, the first line item, that has rolled off. So you are correct. These are capital additions, IT specific, that are depreciated, i.e. amortized over a certain amount of time, typically 5 to 7 years. So in these specific projects, it's likely to be a 5-year amortization period. So you will begin to see the accumulated depreciation annually, which will reduce the net asset value, which reduces the return, et cetera, et cetera. So you will begin to see a reduction in these amounts up and through until they completely fall off.
Thank you. And related question, looking at the second item, the DER map, I noticed the depreciation expense from 24 to 25 significantly reduces. Is that because that asset is going to be fully retired in the rate period? I mean, so there's only a portion of the remaining depreciation expense to be recovered?
We could just have a minute, we can confirm.
Sure.
Yeah, I mean, it's not in the known and measurable, so. So the answer to the question was yes, that they're rolling off. The investment is almost fully depreciated. So that's why it is reduced as much as it is.
Okay, so we can expect in next year's filing, unless there's some new investment into the same line item, that would also be rolled off. I mean, based on the, I guess just to confirm, last year, the depreciation expense over the rate period was 105,000, going down to 30,000. My assumption is that that's because at some point into the rate period, there will be no further depreciation expense on that line item.
I think that's a fair assessment, yes.
Okay, thank you. I have a couple of questions about carrying costs, starting with the response to OCC 8, which was again, Mr. Shelnitz and Ms. Peruta. Well, sorry. I'm really going to ask about OCC 14, which was a follow-up response to OCC 8. So the reason I reference OCC 8 is we asked about the carrying costs being recovered. The question specifically on OCC 8 was the carrying costs from July 1st, 2024 through the May 1st, 2025 adjustment. So from technically spanning kind of 2 rate periods, if you consider the July to September of last year as one period and then September to now. And the response initially to OCC 8 gave us this $4.8 million figure. We asked OCC 14 for the breakdown of that 4.8 million. And I noticed, well, I have a couple of questions about that. I noticed that the one item on here for which the carrying cost is being charged at the weighted average cost of capital is grossed up for income tax as that note describes. And the prime rate items are not grossed up for income tax. Is that because the weighted average cost of capital generates net income, but the prime rate does not?
I think that is an accurate statement. So, the prime rate calculates an interest expense, and that is fully deductible for tax purposes, whereas the cost of capital on equity results from profit, from operating income. And so, yes, it would be grossed up so that it could care for the taxes that will be assessed on the operating income.
Okay. But given that this carrying cost reconciles through a RAM item, does the company look back? Is the company able to kind of look back at a calendar year total net income, which is what drives overall income tax, and determine sort of whether the whack on the CAM, this line item, made its way, like flowed through to the bottom line? I guess what I'm asking for is, does the company reconcile the proportion of income tax that ratepayers are paying through the CAM to the actual income tax expense that's incurred at the end of the year?
Well, I think a few things I would say in response to this is that, and it will be in our comments today, but Pura adopted the use of the prime rate in that revision to the RAM process years ago for some components. You can see others, Pura did not. At the time, the CAM was in a over-recovered position such that we were paying a carrying cost, and that was not altered. So it was retained to be paying at the weighted average cost of capital, whereas for reconciling mechanisms for which we were under-recovered, the method was changed to adopt the prime use netting, the prime rate net of accumulated deferred income taxes. So it essentially mixed and matched concepts, rate-making concepts, at least in my mind. At the time, the prime rate was much lower, such that the carrying charge that we were able to collect on the under-recovered balance was much lower than the corresponding weighted average cost of capital that we were paying out at the same time for over-recovered positions. But there is it's divorced then from costs. It's also divorced from our overall net income. So what we do with these reconciling mechanisms is we try to evaluate what is the cost of the mechanism in total, whether it's an over or under recovered position. The idea would be to apply a carrying charge reflecting the use or source of cash. Pura has adopted the use of the prime rate, but netting that with ADIT, which we argue in our comments today is not an appropriate rate-making framework because it doesn't reconcile back to the utility's actual costs. The prime rate is a proxy. I think it's appropriate as a proxy, but it doesn't reflect our actual interest expense, which is what we actually deduct for tax accounting purposes or tax reporting purposes that result in our net tax obligation. But we don't reconcile to the actual taxes that are paid, because the whole purpose of these reconciling mechanisms, at least in my mind, is to result in a place that we're sort of neutral to the bottom line. So the ultimate, return that we submit is based on all of our operations, all of our revenues, all of our expenses for the core business, for all of these components. We don't say, well, we earned on this particular component and we're going to reconcile for rate-making purposes to that. With these mechanisms, the idea is and should be to get to your underlying costs. So I guess a lot within there. If you're using the weighted average cost of capital as the proxy for the cost to either customers or to the company, from a rate-making standpoint, it's absolutely appropriate to gross it up for taxes. However, I think we've got a little bit of a mismatch here by using the prime rate, netting it of ADIT. If the idea was to have the company recovering the prime rate as a proxy for carrying charges, you wouldn't net it against ADIT, I guess you would have to gross it up for taxes to ensure that we're recovering it. But I don't argue that we should do that because, again, it's really just a proxy. It's not reflective of our actual costs. It's a prime rate. It's a proxy for an interest rate.
Okay, I think I understand. So is the notion of grossing up for income tax essentially that it isn't so much that the company is incurring a tax expense necessarily, but that kind of conceptually the cost of capital is the weighted average cost of capital grossed up for the income tax?
I mean, effectively, yeah, I would say that the whole idea of using the weighted average cost of capital is first recognizing that there is a cost of capital that we need to be able to return to shareholders for the use of that capital, just like a debt lender, no different than a debt lender. We have to pay back our debt lenders. We have to also provide a return to our equity investors. The only difference is the contractual obligation that debt lenders hold against the return of that capital, where equity investors don't, causing them to have more risk, causing them to require a higher return. So when Pura sets the weighted average cost of capital and says, I shall grant you the revenue such that you have an opportunity but not a guarantee to earn that return, you have to gross it up for taxes. Otherwise, we wouldn't be able to actually get that return at the end of the day. So from a weighted average cost of capital standpoint, it's perfectly appropriate to, from a rate-making standpoint, gross it up for taxes, because again, at the end of the day, the idea is that for that revenue stream, we need to collect the appropriate level of return. If we didn't gross it up for taxes, we would pay tax on that return, resulting in less available for shareholders for the use of their capital. Again, for the prime rate, I view it as an entirely different framework. The prime rate is not tied to what our equity investors require for a return. It's just a proxy for the use of funds, and it goes in either direction. And we put this into our comments for today, but conceptually, for instance, in Massachusetts, we rely upon the prime rate for these reconciling mechanisms, again, reciprocal in either direction. There's no grossing up for taxes. There's no offsetting for ADIT. For the reasons I'm saying, it's a proxy to reflect that there's a cost or opportunity loss in either direction. And the reconciling framework acknowledges that a lost opportunity and provides a proxy for what the cost of that is.
Thank you. Does this exhibit include the carrying cost for the EV program deferral that is being recovered in the NBFMCC pursuant to the final decision in 240103?
What was the other data request? The one with the 4.8 million?
OCC 8.
That does include the EV.
But OCC 14 doesn't?
Well, OCC 14 is just providing the rates that were used in each mechanism. So I guess I'm confused by the question.
Well, the EV deferral is being recovered through the NBFMCC, right?
Yes.
And OCC 14 shows that the NBFMCC it only shows prime rate for the NBFMCC, but the EV deferral was allowed at the weighted average cost of capital, right?
Okay. So OCC 14 should be updated to show a sub piece of the non-bypassable for EV that would show it at weighted average cost of capital.
Okay. The total carrying cost allowed on that deferral in 240103, as I understand it, to be amortized over 20 years is 5.408 million. Is that correct? Not 20 years, 20 months. Thank you.
Sorry, what was the question?
That deferral for the EV program to be amortized over 20 months was the total carrying cost was $5.408 million.
If you could just give us a minute to confirm that, we'll go back to last year.
Okay, so what we're showing is $4.2 million, and that is in Exhibit F21 in the March 3rd filing.
Okay. I pulled my number from the final decision in docket 240103 on page 18. There's a table 9 that shows EV program costs for the 20-month amortization, and that shows the carrying costs at 5.408332 million. Is the number that you just referenced like the carrying cost just for the rate period that's being sought in this case? I mean, is that the reason that there's a difference between those two numbers?
We would have to take a supplement to figure out what you're looking at versus what is in this current rate.
Okay. Could the company supplement OCC 14? Could OCC 14 just be supplemented to show the individual references to the this just shows like what the carrying cost rate is being recovered in each line item? Could there just be a supplement showing the drivers for the carrying costs in each line item? And I think Mr. Sheldon, as we discussed before, that would also include accounting for the WACC within the NBFMCC, the proportion of the NBFMCC carrying cost that's actually being recovered at the weighted average cost of capital. Does that make sense?
Yes, and you were looking at what was the amount that you had? You had 5?
Yeah, I guess the question would be to reconcile the number that you just identified on an exhibit in this case with the carrying costs that are identified on table 9 of the final decision in 240103.
What was that dollar amount?
That was $5,408,332.
Okay, we can do that.
Okay, thank you. I have a couple of follow-up questions from authority staff's questions about sort of the nature of the carrying costs as they're reflected in the exhibits generally. Mr. Horton, you earlier pointed out that actually I'm looking at the time, Chairman. I think I probably have more than 3 minutes on this subject. Do you think it would make sense to stop for? I'm not sure when the authority was planning to break for lunch.
Good question. Do you have more than 30 minutes or?
Between me and Mr. Zablowski, I'm hearing that we may.
Okay, then let's go ahead and take our lunch break. Appreciate that. So we'll break until 12:45. Thank you.
Thank you.
Thank you. Please be seated. Great, welcome back. We'll go back on the record in 250103 and resume cross-examination by the Office of Consumer Counsel. Attorney Wheel, please.
Thank you, Chairman. Mr. Horton, I was about to ask you a question about the discussion you had this morning with Pura staff regarding the way the balance is accounted for on a month-to-month basis on the various exhibits. And during that discussion, you pointed out that the carrying charge impact can be reciprocal, meaning like over-earned balance, and an over-earned balance results in carrying charges credited to ratepayers. You remember talking about that?
Yes.
Okay. And I think I also heard, maybe it was Mr. Shelnut's reference that when asked why the company presents these exhibits in this way, that there was a precedent that this is the way the company had always calculated carrying charges for the RAM. Is that correct?
That's correct, to the best of my knowledge.
Okay. Has the company ever looked back in time to determine overall whether the reciprocity that you referenced, Mr. Horton, has weighed in favor one way or the other?
I know that we did during the course of the updated RAM guidelines proceeding, which was conducted at the end of 2020 and resulted in the current process that we're in right now. At that point in time, for the period that we had looked back, so that was 2020, I think we looked back maybe a decade. I can't quite remember, but I know it was on the record. We had net paid out to customers more in carrying charges than we had collected, meaning that over the course of history, we were just happened to work out to be on a net balance under recovered, I keep doing that today, over recovered, such that we were paying carrying charges more. In 2020, the forecast for the supply market didn't, of course, anticipate COVID happening and the impacts associated with that then corresponded to also relatively new PPA agreements at the time, which resulted in an increase on July 1st, 2020. And now since then, we've been sort of chronically under-recovered, which is not surprising given that we're using prior year's actuals to set current year's rates in a time of generally rising costs. We're going to be constantly under-recovered, charging customers carrying costs if that trend continues and the process isn't changed.
Thank you. And you mentioned that general aspiration to, in a perfect system, to forecast perfectly, which you also mentioned those comments that are due in that other docket today. I'm highly aware of those. I myself have to file those before 4 o'clock, so I'm trying to speed up here. And I think we have said in other contexts that we agree, maybe in last year's RAM, we agree that I think everyone probably agrees that all else equal, if we could hit the, I think that's everyone's shared mission in rate making in general, right? That if we can make the revenue requirement exactly match costs, then everybody's better off. But under the current method, if Pura gets the revenue requirement right on the button, if we all do, if the rate order in this case gets the revenue requirement right on the button, isn't there guaranteed to still be an under recovery next year?
How so?
Because the revenue requirement is because as of December 31st, 2025, the company will record the revenues it hasn't yet collected between December 2025 and April 2026 as an under recovery.
Oh, I mean, so I think isn't that completely consistent with what I was saying this morning? It was intended to be, which is that, yes, under the current method, we're not setting the rates the way that you just described. The goal, it can't be that we're setting rates to perfectly collect our costs. I can tell you with certainty, under the current method, we won't, because the current method doesn't take into account the fact that when we set rates on May 1 of any given year that are supposed to be in effect for 12 months, and then we go to do the reconciliation, we're looking at an entirely different time period from which that revenue was intended to be in effect. Yeah, so I think that's my point. The process right now is designed in a flawed way. It should be adjusted.
Okay, so
it seems to me the way to adjust that process would either be to change the rate period to match the calendar year or to change the accounting methodology to match the rate period.
Well, I don't know that we can adjust the accounting methodology. We have to account for generally accepted accounting principles and follow those rules. But I think, again, it's not just that. Because if we were to just align the revenues with the expenses, which we've tried to do for a large adjustment in this proceeding as a known and measurable change, we're still relying on last year's actual experience and setting the current year's rates. And then spending a lot of time talking about whether or not something should or shouldn't be known and measurable. We're using that terminology and accepting it for some adjustments, but not others, like the ESI. I think we should be trying to get to a place where the actual revenues and expenses are set in a way that incorporates best available information for the period that the rate is in effect.
Understood.
I do think if your question was as to the fact that the rate is in effect for a different time period than the expenses are to be recovered is very confusing and doesn't really do much. I think having the rate change on, shoulder months is sound and makes a lot of good sense. But having it be misaligned with the costs that we're reconciling, it just is a confusing element that I'd also advocate should be looked at.
Thanks. Yeah, my question was again, like under the hypothetical, if you'll accept it, that the revenue requirement does somehow exactly match. The revenue requirement is allowed in a RAM proceeding does exactly match the level of revenue, the cost that will be incurred in the rate period. Nonetheless, there will still be an under recovery because of that mismatch, because the under recovery is measured as of the end of the calendar year. So that was why my question was, it seems that the two options to resolve that conceptually, if you exist in a vacuum where there are no generally accepted accounting principles, one of those two things would have to change, right? Either the way that the rate period needs to align one way or the other with the accounting methodology. Is that correct?
Yeah, I'm with you. I think exactly. So again, if I think about Massachusetts, we have the rate period is aligned with the expense period, January to December. It's not off cycle like it is here. Right.
Okay. Thank you. I have a couple of questions about the ESI based around the response to OCC 9 attachment 1. So my first question is, I'm looking at the PDF version, so I don't have like column names, but I'm looking at the column labeled total in rates under the July 1st, 2024 rate section. And I'm looking at the total number, which is on line 27, 60,779,904. I'm noticing that there's a difference between that number and the number right next to it, which is the actual 2024 number, which is at 65 million. Just for clarification, is the reason for the difference between those numbers this exact same thing we were just discussing, that the total in rates is misaligned with the actual calendar year costs?
So in that instance, I believe it's the difference is because in 2024, the known and measurable for our current rate year has not been allowed. And in the estimated May 1st, 2025 rate, it is in there.
Okay.
That's the misalignment there.
Okay, understood. So the column on this exhibit that says actual 2024, is that not referencing the actual calendar year cost of 2024? I guess I'm confused. I'm looking at this exhibit in the context of the conversation we just had, where there's a truism that if the amount imputed in rates does match actual incurred costs, that there's still going to be a mismatch between the rate period and the calendar year period. Are these numbers presented acknowledging that mismatch or not?
I think I think that mismatch is probably implicit in the numbers. And I think we identified it there's another data request where we were asked to make the same calculations that we did for the SBC and the non-bypassable FMCC for the other trackers. I don't recall the data request number, but the value is in that data request. We did it for the ESI.
Okay. Thank you. And we were just talking a minute ago about the known and measurable request from 2024, the 6.9, I think it's the same number that's referenced on this exhibit underneath known and measurable 2024, the total down the bottom that says 6.972 million. So that's the difference between the total and rates and the actual 2024 number.
Correct. The known and measurable in 2024, that's in that second column, that was the approved known and measurable. When you move over to the actual, those are the actual costs that were incurred in calendar year 2024.
Okay.
So that's what is reflected today in our request for the May 1, 2025 rates.
Okay. And I noticed that the 2024 known and measurable, that's 6.972 million, is like, it's about half it grows by 60% if you look at the known and measurable for 2025, which is 11.289 million. I was going to ask why there's such a big jump in known and measurable, but is that because the known and measurable for 2025, is that because the known and measurable 2024 number here doesn't include an amount the company requested last year?
That's correct. So at least in the last several years, we have included, if not a known and measurable measurement in our rate filing, certainly a known and measurable other explanation of the ESI, just the pancaking effect of what the ESI rate itself is, that every year you have a new year of capital costs that are placed in service that qualify for rate recovery. And so what the company has done annually is it has presented based on an actual known and measured amount that we know will occur in the calendar year that we are presenting for the rate setting process. And every year it has been disallowed. So you will always see that type of a disparity between, an analysis like this where you are comparing the approved known and measurable rates as opposed to the known and measurable amounts, the approved known and measurable costs from the prior year compared to the known and measurable costs that the company is proposing. Because we will continue to put that number in as a request because it truly is a known and measurable in our opinion from the standpoint, as Mr. Horton mentioned earlier, the known and measurable concept we've been struggling with for years, but on the ESI, it probably is the most truly known and measurable cost that we know will occur.
Okay, thank you. I had a couple questions about the storm cost request, starting with OCC 26. Which was Mr. Horton, Mr. Shelnitz, Ms. Peruta sponsored. OCC 26 responds that the company is seeking to recover this amount, the $75 million, through the NBFMCC. Why does the company feel that NBFMCC is the appropriate rate mechanism for this?
Yeah, and we did explain, I think in that response that we'd be open to others. We included it in the NBFMCC in our initial filing because we have had in the past similar types of funding mechanisms provided for through the NBFMCC in the past. But we indicated in this response as well, because we know that there's a lot of focus on the public benefits portion of the bill, which the NBFMCC is a component of. I mean, we would have no objection to the replenishment being established in a separate mechanism that doesn't appear in that line item.
Thanks. Has the company ever recovered storm costs or storm reserve costs outside of distribution rates before?
Just to be clear, we're not seeking, and we put it into a number of responses here. It may sound like a nuance, but it's extremely important. We're not asking for PURA in this proceeding to authorize recovery of any dollar amount. We're not asking for PURA to establish the prudence. We're simply asking for PURA to consider establishing the replenishment of a severely depleted storm fund, a customer liability to the tune of $1 billion at this point in time that we know will be paid for through customer rates in the future. So our request is one that would help customers avoid future rate whiplash rate increases and avoid a substantial amount of carrying charges on whatever the amount of storm fund balance that is ultimately approved by PURA, which is certainly far in excess of $75 million. We've incurred about $1 billion of unrecovered storm costs at this point in time. That is just a growing balance that in the future would be reflected in rates, would accrue carrying charges at that point in the future. So from a customer perspective, particularly given that we have an opportunity right now that rates are lowering, customers can begin to pay a modest replenishment of the storm fund, not determining prudence, not ultimately recovering costs, but offsetting a future significant liability to avoid carrying charges and to avoid significant increases in charges, or at least to mitigate that at some point into the future.
Thanks. And that is why I did ask whether the company's ever recovered storm costs or storm reserve replenishment funds. But my question was has that ever happened in Connecticut outside of base distribution rates?
I'm not aware of it happening in Connecticut outside of base distribution rates. In Massachusetts, and we put this into our responses as well, there the department understands the framework that I just laid out, that having customers, accrue carrying charges and pushing costs off to the future is not a benefit to customers. In Massachusetts, there's a framework where we have a more regular cadence of the rates matching the costs. And just like every other component that we talked about here, at the end of the day, Mr. Wheel, you just said that the goal of all of us, which I hope it is to have revenue requirement match rates. If that's the goal, then there's really no reason to try to avoid having this replenishment factor go into place for the benefit of customers. Again, it's not ultimately determining the amount that customers will pay, but simply what it's doing is saying at that point in time when customers will pay some balance of storm costs in the future, the impact on customers will be less in terms of a rate impact and less in terms of an overall cost.
Thanks.
So in Massachusetts, sorry, just to complete the thought, there is recognition that that is not a base rate item, that this replenishment concept has value to customers, and the DPU in Massachusetts allows for rates to be set outside of base rates for storms.
Thanks. Do you know if the rate class allocation for the NBFMCC is the same as for the distribution rate?
No, it's not.
Okay, so if this storm reserve were replenished through the NBFMCC, those costs would be allocated in a different way than the storm reserve is currently allocated through distribution.
Yes, and the calculation also.
Okay. And the company is there an element in base distribution rates right now where on an annual basis, the company does get revenue to replenish the storm reserve?
So there's $3 million for pre-staging set in base rates for pre-staging. There's $3 million for catastrophic storm recovery. And then there are certain prior amortizations that have rolled off that have been used to offset the balance. And even with those amounts, the amount, and I think we put this into one of the responses as well, I believe the amount in rates that is going right now to fund the storm reserve balance is approximately $60 million for a balance that's $1 billion. And again, we're not asking for PURA to determine here whether or not that full $1 billion or any portion of it is prudent, simply acknowledging that there is a $1 billion customer liability sitting on our books, that the amount in base rates is simply woefully insufficient to fund, such that in the future, when it's allowed, would cause sizable rate increase and have greater overall carrying charges, just following PURA's existing precedent. That by having a replenishment start sooner will help to mitigate both of those negative customer impacts.
Thanks. I have a question about OCC 28. This is sponsored by, I think, the same witnesses, Mr. Horton and Mr. Shelnitz and Ms. Peruta. There's a line in here that says, PURA has acknowledged that aligning RAM rate adjustments with expected rate increases or decreases in other rate mechanisms serves to mitigate rate shock, which is consistent with the principles PURA must take into consideration when determining the level and structure of rates. But the proposal here is to recover $75 million annually in the MBFMCC until the next distribution rate adjustment. Is that correct?
That's correct.
So is it possible that next year, my understanding is the basis for this quote that I just read was in support of adding this now because this year there's a slight rate decrease. Isn't it possible that next year there could be a rate increase that would nonetheless still include this $75 million line item?
And if you think about it, so if we imagine a world where Pura declines to adopt this proposal, which is intended to save customers money, and we get to that future rate case and begin to recover that customer liability at whatever the value is, not been offset by any replenishment, it will be greater than had customers paid into the pot. I think we could all agree. So at that point in time, the framework would be customers will be paying a fixed amount over a set number of years that's greater than what they would have paid if Pura adopted this proposal. So yes, in that framework, customers would still have been worse off because we have no idea what the annual rate changes would be in that future scenario, which would happen in the absence of this proposal. So yes, here we're focusing on rate changes. We're trying to mitigate both rate changes and overall customer costs. And we would like to try to seize the opportunity to be able to start this process at a time when rates are naturally declining to avoid that happening in the future, when customers would, again, just have to be paying more and have rate increases be higher. And then any volatility that happens over the period of recovery would similarly just happen on top of whatever that amount is.
Okay. As we just discussed, the $75 million isn't to recover storm costs and it's to replenish the storm reserve. So when the company collects this $75 million through the MBFMCC, is it going to just keep it in the storm reserve and not use it until the next rate case?
Yeah, so great question. That's not how utilities work. It is a great question. So first, I do want to be clear that this storm replenishment, there's a lot of focus and attention on shareholders, especially in Connecticut, and profits. This would not be going towards Eversource profits. What happens is we record the expenses as incurred for storms, and we record them to a regulatory asset on our balance sheet. You know, a regulatory asset is a customer liability. So that asset is at this point standing at about $1 billion. If we have money coming in, we would simply be recording an offset to that regulatory asset again, so that when we get to the point in time where Pura has determined the full amount that's recoverable and establishes a specific rate for that targeted recovery, the amount would be lower. So we're going to use the funds to fund the business, to fund our operations. Just like today, we've used funds that are coming from operations that have been paid for through debt lenders or equity investors. We've financed and paid out all those billions of dollars that are sitting on our balance sheet. The replenishment would go towards, paying back those debt lenders and equity investors, if you will, but not in the form of net income. It's simply additional revenues flowing in to fund the business.
Thanks. So, I mean, the reason we issued the interrogatory, it's similar actually to a conversation I think we had last year about the ESI, which is there ever going to be a point, even after the next rate case, where the company would be able to connect the $75 million they're collecting annually now to be able to explain to ratepayers, yeah, this $75 million you paid us in 2025, here is what expenses that covered?
Okay, so well, help me with that. I don't quite follow. I want to be able to answer.
Yeah, I mean, the question we posed was I don't have it in front of me. If we issued an interrogatory essentially saying like, what exact storm costs are the $75 million going to pay for? And I read your response and heard your testimony here today. Which is, well, it's not paying for storm costs. It's paying as an offset to the regulatory asset, but it eventually pays for the storm cost the company has incurred. So if I were to explain to a ratepayer, here's what you're paying for this year. Here's what your dollars are contributing to. Eversource had to respond to this storm and put the lights back on in this town. Am I ever going to be able to do that? Like, am I ever going to be able to justify to a ratepayer why they're paying now for costs that aren't yet identified?
Yeah, great question. And I think if we take a step back on both of these questions, I think if we're talking to customers, I certainly feel like we can get to a place of explaining both your question on the MBFMCC and this question you're asking on storms, like what am I paying for? I think we might need to work at it, but get to a place of being able to have that conversation, and we should and we need to. Our customers deserve that. When we're talking about the MBFMCC, perhaps I was getting a little bit too fine to answer your question with specificity. Like for a customer, I'm not suggesting that we don't need total and complete accuracy. We do, but we also probably don't need to bore them with all the nitty-gritty details that I walked through around prior year over and under recoveries, which is part of the complication we have, and we don't have revenue set at each level. But I don't see the challenge. If we were to be able to, if we wanted to explain to a customer, well, how much are we paying? We keep here Eversource talking about $1 billion in storm costs. Aren't I paying for that, and how much? I mean, yes, we would be able to say, well, currently we have whatever it is in that record request, $64 million, which is going to fund the storm fund. We're asking for PURA to allow for an additional increment to go and fund that storm fund. But Mr. and Mrs. Customer, the point is that the full balance, nothing will ultimately be authorized for recovery until PURA gets through its review and determines that every dollar it's authorizing has been prudently spent. And if in the end PURA determines that a certain amount is not recoverable and customers have paid too much, they'd get a credit back. But certainly at this point in time, current customers have had the benefit of $1 billion of storm cost restoration and have not paid anywhere near that amount through their rates. So future customers, in the absence of a proposal like this, we would need to be explaining for them, well, you're paying whatever the number is that's approved for storms that happened a decade ago. So this, as well as another added benefit to be able to make that conversation a little easier in my mind, we're asking customers to pay a portion to replenish the storm fund that has been depleted given the weather events and the severe impact they've had in our system. And also, we're avoiding a future impact on future customers that will only serve to exacerbate future rate impacts and cause overall bills to be higher at a time where we're looking for every single dollar we can to be saved for customers.
Thank you. I'm going to ask some questions about OCC 5 and OCC 24. Which are regarding internal O&M expenses recovered through the NBFMCC and the SBC. So in OCC 24, we received OCC 5, which was identifying those costs. Then in OCC 24, we requested a breakdown, and we got the response. What we were asking for was similar to like the theme that I've been going through so far, is a breakdown explaining what exactly we're paying for in the O&M expenses, as opposed to just like the amounts and the, like it says SCEF $315,000. Like, could we get a narrative explaining like what we're paying for in SCEF in O&M expenses and all of these line items?
Yes, we can supplement that.
Okay. Thank you. I have some questions about Millstone, Exhibit F, PDF page, oh, sorry. Lost my page number. Well, I'll start with page 3, I think, which is the page 2, PDF page 3. So line 31 shows the actual incurred costs of Millstone were about 65 million. And then that dropped to around 56.5 million about in 2024. So that's a reduction of a little over 12%. Is that correct?
Correct.
Okay. And those are net costs. So they're the net amount of the difference between the cost to purchase the energy and energy attributes, and then the revenues for selling those. Is that correct?
Correct.
Okay. And if I go to page 17 of Exhibit F, labeled page 17, PDF page 18, that shows the breakdown of those costs and revenues, right?
That's correct.
Can you describe the mechanics of these transactions? Like, does Eversource choose when to purchase the energy and attributes and then choose when to sell them?
For the energy, no. Eversource does not choose when to purchase it or when to sell it. That's all handled by the facility. The attributes are, yes, the sale of the environmental attributes is handled by myself and my team.
Okay, thank you. So I just learned this when talking to UI, embarrassingly enough, I didn't know before Wednesday. It's sort of like an automated process for the energy, right? Like it's both the purchase from Millstone and the resale at ISO New England happens like without any like direct conscious interaction. Is that correct?
So there's no interaction from anyone on our team. No, we're not sitting at a computer and saying buy, sell, sell, sell.
Okay. The reason that I was asking these questions to UI on Wednesday is, and I won't ask anyone to speak to UI's filing at all, but there is a difference in year to year between the two companies. If you look at that percentage that I just mentioned, there was from 2023 to 2024, there's a 12.28% decrease. There's a different number for United Illuminating. And I've been trying to understand why there would be a difference given that both companies use this sort of automated process. Could you explain why there might be a substantial difference between the performance from year to year?
I can't, and I also can't speculate that it would be based on performance, because obviously we each have our own buyer's percentage entitlement of the output of that facility. And so ours is about 41-ish%, and I think theirs is around 10, give or take. So our numbers year over year should roughly be 4 times more than what theirs are.
Right, but that's why I converted it to percentage, right? Because if the number for UI was 100 and your number was 400, then the next year UI's was 200, you would expect yours to be 800. But the percentage growth between year to year would be the same between the two companies, and that's what's different. So do you understand why I'm confused about that?
Yeah, I will say that I know we have a filing that I believe is due on Monday, going in on Monday, subject to check. That explains those differences year over year, and maybe that might help shed some light from company to company.
Okay, great. Thank you. I'm going to switch to questions about the low-income discount rate. Mr. Trainer, I'm sure I'm waiting for. So it's my understanding that there is a known and measurable adjustment to the SBC, which is inclusive of an adjustment. The reason I paused there is, I'll explain in a second, to the LiDAR. But the adjustment, as I understand it, is to adjust the 2023 actual to the same level that was projected for 2023. Is that an accurate understanding?
That's correct.
Okay. So although it's an adjustment from actual, it's actually not really an adjustment to the number that's used for the actual rate. Is that correct?
That's correct.
Okay. And that number that was derived, I think there's a reference in the testimony that estimate was provided in the last RAM docket 240103. Was that estimate, the $112 million estimate, derived using a calculation that included the actual total bill cost of electricity at the time?
It was a combination, excuse me. It was a combination of a couple things. It was an estimate, I believe in 171203 RE11, that the 2-tier discount would be approximately $101 million a year. So that was 101 million, and then it was an additional 10, 11 million from I believe it was the LIDC that was in the SBC. And the LIDC was $25 credits to customers over the first 6 months of 2024 to act as rate relief during high supply rates.
Okay. I know I and other OCC representatives have asked you these questions in a lot of different contexts, but given that rates the total average bill is significantly different now than when the initial 171203 RE11 LiDAR proceeding was happening, has the company not considered whether the total cost of LiDAR might be more than was modeled in the past just by virtue of that increase in overall bills?
It potentially could be, but with the variability of the changes to the LIDR this year, and at the time of the known and measurable filing, there were a lot of questions that we didn't have answers to on which direction the LIDR cost was going to go. So that's the reason we kept the cost the same as it was last year for
Okay.
LIDR.
Understood. So essentially, I mean, disagree with me if necessary, but essentially, there's still enough uncertainty that there isn't a reason to depart from that $112 million number. Is that accurate?
That's correct.
Okay.
Yeah. There's so many changes going on. We haven't had what I would call a steady state year for the LIDR at this point, since we're just over a year in and expecting additional changes this year.
Okay, thanks. And this morning, in response to Purist staff questions, you were discussing the potential for an impact of the self-identified customer standard that's in the current draft decision. Could you just explain that one more time?
Yeah, so in the current draft decision, our interpretation of the directive in that decision is for all customers who self-identified, meaning customers who were potentially originally on Tier 1, providing additional information such as benefits from the Department of Social Services or income documentation that then qualified them to increase their 10% discount to the 50% discount. And that's because today, the way the information we're getting from the Department of Social Services, we do not put customers on Tier 2 based on that data sharing alone. Customers need to take the additional step, whether it's opting in to the DSS data sharing, whether it's going to a community action agency and getting energy assistance that qualifies them for that higher discount, or by providing qualifying benefits or income directly to Eversource.
Okay. Thank you. I'm going to cut some of my questions in the interest of time. I have one question I'm not sure who to ask. My question is whether there's recovery anywhere in the company's RAM filing for a Neal insurance policy. Not sure who.
Yes, that recovery is in the CTA.
Okay. And could you explain, I was again talking to UI on Wednesday, they have a line item in their NBFMCC for a credit through this policy, and I asked them specifics and they responded, as I understood it, that Eversource is the named policy holder. Can you explain why there are credits going to UI through that policy?
I could not explain why there's credits going to UI.
Okay. Do you think if we issued an interrogatory, the company would be able to respond to that?
Yes.
Okay. Thank you.
Ms. Peruta was prepared to speak, but she's not feeling well and just had to.
Okay.
She probably didn't want me to say that. She did send me an email, but I think we'd better off.
Okay, sure. I have a quick question about, there's a line item in Exhibit H for the SBC for a gross earnings tax impact associated with the LiDAR. I noticed that year over year went up 3,500%, and I assume that has to do with the kind of partial year LiDAR effect that we talked about before. But my actual question is, does the company make known and measurable adjustments to gross earnings tax or any other tax expense based on their expected revenue change from their RAM filing?
To the extent a known and measurable adjustment changes the revenue requirement upon which a rate is set, and that rate has GET applied to it, then the rate calculation would take into account that change.
Okay, so like there's GET again in the SBC. If the company were seeking a known and measurable adjustment as they are in this case, for instance, to the LiDAR, there was 93 million, I think, in the LiDAR actuals last year, as I just discussed with Mr. Trainer, there's an adjustment up to 112 million. Is there also an adjustment for the GET? Is the company also seeking a known and measurable adjustment to the GET in light of the fact that there will be millions more revenue coming through the SBC?
Subject to check, I think our calculations of known and measurables, if it had a GET component, subject to check, I believe we took that into account in the known and measurable. There's only two items in all the adjustments that have a GET component embedded. One of them is the LiDAR, and the other is the Hydro-Quebec over in the TAC mechanism. Those are the only two line items embedded within these rate mechanisms that I believe have a GET component associated with them. The answer that I gave before was talking about the GET that is applied on top of the rate itself. So not those two items that are embedded.
Okay, understood. So is there like a general, that's the question I'm getting at is there's a known, at least using the assumption that the company's requested rate adjustment will impose a known change to revenue. There's a calculable known change to GET. I'm just asking if that known change to GET is included, is like part of the revenue requirement for the RAM pieces or not.
Subject to check, we would have cared for that, yes.
Okay, thank you. My last questions are about the TAC on Exhibit 8G. And I've just magically, silently heard that these are our last questions. Mr. Saplasky does not have questions after me. We have like a, we have a strong connection. So Exhibit G, page 2 of that document, which is PDF page 3 on line 12. Why are LNS and Schedule 12C costs combined into the same line item?
I think that just goes back to the way it's historically been presented. They certainly can be broken out.
Okay. And can you briefly explain the difference between LNS and Schedule 12C costs?
Sure. LNS, the LNS rate recovers costs associated with our local transmission system. Schedule 12C costs rate includes recovery of our PTF investments, which typically you think of PTF investments as recoverable through RNS rates. However, at times, ISO New England will make a determination that certain components of PTF investments should be charged only to customers within the state due to some particular circumstances. So that's what the 12C does.
Okay. Would it be possible to provide a supplement to this exhibit showing the breakout between LNS and Schedule 12C?
Yep.
Okay. Thank you. And that is finally OCC's last question. Thank you. Thank you to the panel.
Thank you. Attorney Marshall. Thank you. Commissioner Karen.
Questions?
I don't have any questions either. Did the company like a minute to consider redirect? Okay, we will recess for 5 minutes.
Thank you.